Hi, and welcome to Early Retirement Roadmap, the channel where I help you prepare for and thrive in early retirement by someone, me, that is not a financial planner, but someone that has successfully retired early at the age of 55 last year and is living it. If you're retired or close to retiring, you don't want a second career babysitting your portfolio. You want a simple, lazy plan that's smart. By the end of this video, you'll have a setup you can run this week. Certainly no day trading and no 47 fun complex puzzle. Not retired yet? Stick around anyway because these rules work for anyone who wants a low maintenance way to invest for the long haul. Lazy investing means automated and rules-based and purposely quite boring so you can live your life. Because we're using broad index funds, you don't need to check markets daily, and I certainly would advise against that as it can make you crazy. And since you're invested for the long haul and because the lazy way spreads your risk, you don't need to be constantly looking at the daily ups and downs of the stock market. Why index funds? Because there has been tons of research that has shown they outperform managed funds almost all the time. And because they follow an index and are not actively managed, they have much lower expense ratios, meaning you're keeping more of your investments. Let's start with the portfolio. My base is US focused and index based, no individual stocks. You'll hear some advisors suggest an international slice, and that's a preference call. I skip it because many US companies already earn a lot and are invested overseas. And in my experience, my US focus mix has performed better. If international helps you sleep at night, keep it small and use one broad index fund. Keeping it US and index based though, use three easy categories. First, the foundational category, which is a broad US market index fund or an S&P 500 index fund. That's your base. The growth category is a low-cost U.S. growth index that adds growth, of course, but with a trade-off of more volatility. The income category can be a diversified U.S. dividend index for equity income or a bond category for stability or both. Here are some great examples of each category, not recommendations necessarily, just some popular and good ones to research and evaluate to get you started. For the foundational category, think the Vanguard ETFs or exchange traded funds, VTI, that's an index of the total US stock index, or VOO, that follows the S&P 500 index. For the growth category, check out Vanguard's VUG as an example, and for the dividend category, check out the Vanguard funds VIG or VIM. Set the mix of these categories by age and your sleep at night comfort. For example, in your late 50s, perhaps about 40 to 50% foundational, 15 to 25% growth, and 30 to 40% income. I'm not going to get sidetracked in this video of the category mix by age and based upon how far you are away from retirement as well, because you can easily research that on your own. And there are lots of YouTube videos and information on the internet, and that's a subject quite honestly, for a dedicated video alone. Once you have your mix, then rebalance when a category drifts plus or minus 5%, and a lot of people just rebalance annually, and that's what I do. Once you set your mix, the next step is making sure it fits your lifestyle and risk comfort and placing each piece in the right account so taxes don't eat too much away. Taxes, the word we all hate. You do need to be very thoughtful about them. For example, use ETFs and taxable accounts. They're designed to minimize capital gain distributions so you control when gains are realized. Avoid index mutual funds in taxable accounts. They can kick off involuntary capital gains you didn't choose when the fund managers rebalance the fund, usually annually, to realign the fund with the index it follows. I learned this the hard way a few years ago, so learn from my mistake. And I have a whole video about this. I'll include a link to it in the description. Another example, put any bond funds and or real estate investment trusts or REITs in traditional tax-deferred accounts like an IRA, 401k, 403b, for example, or Roth accounts. This is because interest and REIT payouts are taxed as ordinary income. So sheltering from tax is what we want to do. Another example is to keep broad stock ETFs in taxable accounts because qualified dividends often have lower tax rates. Capital gains tax is usually deferred until you sell, so you have control of when you get hit with capital gains tax, and you can harvest losses if needed for modified adjusted gross income or MAGI control if you're on ACA health insurance to maintain subsidies. After having talked about the tax side, now let's protect the plan from just bad timing. Build a 2 to 4 year liquidity runway so you're not forced to sell stocks during extended downturns. Why 2 to 4 years? When there's a bear market, that bear market and recovery can exceed 24 months, with average recoveries taking about 2 to 2.5 years. And remember, that's the average. So a multi-year runway bridges both the drop and the climb back. But it's a trade-off. More comfort and MAGI flexibility versus some cash drag. For example, on a 4-year conservative plan, consider putting years 1 to 2 in true cash. Think a high yield savings fund or money market. For years 2 to 4, consider having that money in near cash options like a CD ladder and or short duration treasury inflation protected securities or TIPS. Next is how you take money out. Start with a sensible withdrawal rate based upon your time horizon, then add rules that flex with real life. If you retire early, the traditional 30-year retirement span may not work for you, as you might be retired 40 years instead of 30. So a 3% withdrawal rate might be the right choice for you. For roughly 30 years, 3.5 to 4% can be reasonable depending on your risk mix and comfort. But you're not using a withdrawal rate alone. You're also going to add guardrails for flexibility because, well, life just happens. What if your HVAC system in your house needs to be replaced or you want to help pay for your daughter's wedding expenses? You're going to have unexpected expenses, so we want to be able to flex for those. Guardrails exist because life isn't a smooth line. Think of it like cruise control on your car. You set the speed, and if you drift above or below, your car makes small adjustments to stay at that speed. What it looks like in retirement is you pick a band around your starting withdrawal rate and only change when you leave the band. For example, start at 3% for long retirement and set a plus or minus 20% band, which would mean a 2.4% to 3.6% withdrawal rate. How this works: when the market's down, dial your spending down within the band. When the market is up, you could move closer to the upper range of the band. Just stay inside the band and don't overshoot. And this band is what gives you flexibility when you do have those large unexpected expenses and you need to withdraw more than just a flat 3% withdrawal rate. Now let's talk taxes and the order of withdrawals. Where your retirement income comes from really matters to save on taxes. In general, tap your taxable accounts first, then your traditional tax-deferred accounts like a traditional IRA, 401k, or 403b, and keep Roth accounts as your flexible reserve for later years or surprises. And this strategy allows your money to grow tax-free as long as possible. Roth conversions are always a big concern for retirees, and that is a topic for yet another whole video. But in short, Roth conversions mainly make sense if you have a large pre-tax balance or expect higher future tax brackets. And if you're thinking about doing them, you have to watch Modified Adjusted Gross Income, or MAGI, for Affordable Care Act subsidies before 65, and also Income-Related Monthly Adjustment Amounts, or IRMAA, for Medicare after the age of 65. And finally, once a year, run an annual tune-up. First, check whether any category, remember our 3 categories of growth, foundational, or income, drifted beyond 5% of your intended band for each and rebalance. Second, refill your cash runway if you needed to pull from your cash reserves in a bear market to fund your retirement. Third, run a tax check. Look at realized gains, your withholding or estimated taxes, and your projected MAGI. Now, the day that I'm recording this is November 14th, and at the time of this recording, we know the government shutdown has ended, with the promise of talking about extending the enhanced subsidies as a separate conversation. But if those enhanced subsidies are not continued past 2025, and it's quite frankly not looking great that they will be, you may want to monitor your MAGI quarterly rather than annually, because going over even $1 of the subsidy cliff would mean you're paying full price for the premiums and getting no subsidies at all if you're on an ACA health insurance plan. That subsidy cliff would be 400% of the federal poverty level, or FPL, based upon household size, and 26 will use 2025's levels. I'll include a link to the FPL tables in the description, but you would need to be very mindful of that if the enhanced subsidies are not extended past 2025. I would also suggest doing a MAGI forecast at the end of March, June, September, and early November and adjust withdrawals, Roth conversions, or capital gain harvesting to stay within your target for those subsidies. I have a free MAGI calculator Excel template that will help with this that I'll include in the description. After that, upload your withdrawals for the year as best as you can using your guardrails. If you're inside the band, great. If you hit your upper guardrail, trim back to better line towards the middle. If you hit the lower guardrail, give yourself a raise to get back towards the middle. I mentioned this as an annual test, but certainly during the year, check quarterly and see where you're landing in your guardrail bands. If you're still inside your bands as expected and MAGI is on target if you're on ACA insurance, you're good. If a guardrail is hit or a big expense pops up, you can use your cash reserves now to nudge spending back towards the middle as a possibility. This avoids selling stocks at bad prices and refills your cash runway later when markets recover, if that ends up being the situation. Lastly, finish with basic account hygiene if needed. Confirm beneficiaries and titles, add or verify a trusted contact, refresh passwords, and your in case of emergency document. If you're under 65, review health plans and MAGI targets during open enrollment. If you're 65 or older, review Medicare Part B and Part D choices and next year's IRMAA bands. Here's a quick recap. Choose a simple index core, decide your mix and stick to it. Build a 2 to 4 year liquidity runway, pick a starting withdrawal rate that matches your horizon, and enforce guardrails. Be intentional about where each dollar comes from so the tax bill is smaller, and schedule your annual tune-up so the plan keeps running. Remember, lazy investors aren't lazy, they're efficient. The market tends to reward people who are patient, diversified, and tax smart, and it punishes people who can't stop tinkering with their investments and, well, aren't lazy. Thanks for watching. If this helped, like, subscribe, and leave a comment, and share this episode with others you know who may find it helpful. And in addition to the free MAGI calculator I mentioned, I've got another freebie called 12 Must-Do Steps to Retire Sooner and Smarter. It's a checklist that offers a quick, practical guide to retiring early. You find a link to it in the description. And when you're on the go, catch the Early Retirement Roadmap podcast. Well, that's all for today. This is Mike Upland, early retiree last year at the age of 55, helping you to plan and thrive in early retirement. Take care and make the most of today.